Just starting with the company highlights. Most of these stats have been reported on our quarterlies already. We're just pulling it all together. Monthly recurring revenue is up 26% at 4.6 million at the end of December. Annualized, that's a similar number, up 26% at 54.6 on a run rate basis. Customers were up 13% as a whole at 1,679, and 13,904 services up 20%. The ports is up similarly 20%, 4,863, and the number of installed locations up 6% at 317. In terms of other highlights, we've just launched in Japan, which I'll touch on a little bit later in the presentation, bringing us to 21 countries that we've launched in. We recent cap raise, which we did towards the early part of December, we raised 62 million, now leaves us with 120 million cash in bank at the end of December. Very much focused in the first half of the year on increasing our footprint with our cloud partners. We're adding 24 locations, bringing a total of 156 for the cloud on-ramps, adding 12 new regions, bringing a total to 85. 6 of those locations on the cloud on-ramps came from Japan alone, out of the 24. So up 18% in total for the 6 months in terms of our focus on cloud reach and for customers accessing cloud service providers in more and more regions. Looking at a quick look at the revenue and a breakout in the regional revenue and the growth. Total revenue is 25.9 million, up 70% compared to the same period last year. Going from left to right, the Asia Pac business, 9.4 million in revenue, up 58% on the same period last year. North America, which is the one we've seen the greatest amount of growth, is at 11.4 million, up 108% on the same period last year. And then our European business at 5.1 million, up 34% on the same period last year. Switching to the financial performance and the statements, as I said, revenue was up 70% in the comparable period last year at 25.9. We've seen a dramatic improvement in our gross profit, or as in the financial statements, as a profit after direct network costs, improved by 173%, or 8.3 million in the same period last year. And then our operating expenses also increased in line with our strategies we outlined in the last 12 months of investing in both our people and in our network across the region. Normalized EBITDA is including the accounting standard for leases is 10.3. There's a slide on the end in the appendix which does a comparable pre and post the ASSB impact. And normalized EBITDA on a reported basis was 10.2. And then the net loss for the period was 18.9 million, slightly up on the 16.6 from the same period last year. As I said earlier on the breakdown of the revenue, it's 25.9. The North America business is now contributing the largest part of our revenue. On a full half-year basis, it now accounts for 44% of our revenue. We expect this to continue to grow and surpass 50% by the time we get to the end of the full year. And the APAC region now represents 36%, and European represents 20% of our overall revenue generation. In terms of a breakdown of the operating costs, the direct network costs were 12.7 million for the period. Notwithstanding, we added the additional 17 sites in the period, but we're now seeing the first 6 months of all the sites that we added in the last quarter of the last financial year and the full impact on that. We're seeing also the cost savings come through that. The average cost for the data center is nearly $7,000 per site on a fully loaded basis, compared to 7.4 the previous year, or about half, $500 in the difference between excluding the accounting standard impact on leases. Employee costs, we have 174 staff at the end of December, running up to about 100, including temps, about 190 as we stand here today. So again, one of the biggest costs that we have in our business and employee costs as we continue to expand, not just in our sales organization, but also on our tech front, on our software development front, not to mention new countries that we bring in where we actually need specific people on the ground to interact with customers and our partners. The total operating costs were 23.4, up from 19 at the half year at the end of June, and up from 17 at the same period last year. In terms of the balance sheet, I suppose the only real point to know, apart from the movement on the leases between liabilities and assets, the main takeaway here is that the total cash at the end of the period is 120 million in the bank. This is the first time we introduced this chart, and I've got this broken down by the regional basis further on in the presentation. And I just wanted to show the impact of our operating leverage in our business. You can see going from left to right, this is the month of December in each of the preceding four years, from 2016 up to 2019. The dark blue chart representing the revenue in that period. But you can see, sorry I keep calling it gross margin, but the profit after direct network costs in December 16 for the business was negative 16%, and it's now running at 53% on an exit run rate in December. Our group EBITDA margin has gone from very high negative percentage, is now down to 30%, so it's improved by 50% in just in 12 months just alone on the group basis. But this picture looks very different from APAC, North America and Europe when we go on to the next set of slides. The main takeaway on this one is, as we continue to add more and more revenue, there's a higher percentage of that revenue dropping down into the gross margin, into the EBITDA, because we're not adding costs anymore in the same rate that the revenue is growing in the business. So it's predominantly semi-fixed at this stage. In terms of the regional highlights, just looking at the ecosystem and the breakdown of our network, we're in 552 enabled locations. In North America, with US and Canada being the two countries there, we're now in 65 cities across those two countries, 153 installed data centers, but access and reach to 313 data centers where customers can actually physically connect to Megaport to consume services. In our European business, 14 countries. Remember, we added 6 of those towards the end of our last financial year. 24 cities, installed in 85, enabled in 146. And just recently, we added Japan in APAC to bring us up to 5 countries, 13 cities, 79 installed and 93 enabled. And this will continue to grow as we expand further and further into Japan. Speaking of Japan, it's amazing. Since we did our IPO in 2015, we started this business, I suppose, in early 2013. We're still the only company to launch the first software-defined network in Japan in 2019, 6 years on from the time the company started. We had a lot of planning went into to getting this right in terms of a dedicated team looking at it, making sure we had the right partners, the right go-to-market strategy. Our cloud service providers are very much encouraging us to do that. It's now the 5th largest country in terms of cloud spend at 7.4 billion as of 2019 combined with the cloud service providers. It's the 6th largest financial center. And we've already installed 3 and enabled 8 locations just in Tokyo just before Christmas in November. Further plans to expansion is into Osaka. We're adding an additional 8 sites into Osaka and some into Tokyo. We've already established and built in and connected to 6 cloud on-ramps in Tokyo with AWS, Azure, Google, IBM, Oracle, and Salesforce. And we've now got 4 staff on the ground in Tokyo at the moment to help support customer needs, language, doing business, etc., and our partners. Looking to the Asia-Pacific region itself, 79 data centers were up 8, total ports 2,157, monthly recurring revenue is 1.7 million, customers are 731, services 6,384, and our profit after direct network costs on a reported basis, including the change for the lease, was 72%. It's 67 excluding the lease impact, so you can see what it's like. And just for comparison purposes, it was 62% at the end of June, so it's jumped up 10% on a reported basis, or it's jumped up 5% excluding the treatment of AASB. Looking at that same operational leverage chart for the APAC business, which is our most mature, is the ones that we started out with first with Australia, New Zealand, Hong Kong and Singapore. You can see here how the business has grown over those 4 months, or December in those 4 years. We've gone from a profit after direct network costs or gross margin in December 16 of 11% right out to 72% 4 years later. And our EBITDA margin, while it was a negative 86 back then as we were building out the business, is now running at a 37% exit run rate in December in APAC. As someone asked me on one of the earnings call earlier on, and you recall, Nick will recall this, when we talked about what normal looks like and what a business should look like. This is a 70-something% gross margin business with an EBITDA margin of 40%. And we're getting very close to that where we are now. Is we're not adding that many extra new sites, and we're not adding that much cost or headcount into this business. It's pretty much set and locked and loaded. So this is really about more and more sales coming through, more and more activations, more and more customers, taking up more services, and each one of those services that comes through has a 70-something plus cent in the dollar drop through to the bottom line. So that's kind of one of the reasons why we wanted to show this and illustrate the growth in the revenue and how much of an impact it has on our gross margin and then obviously on the fall through into EBITDA. Switching to North America, as I said earlier on, we've seen the largest amount of growth come from this business. Not surprisingly, at 153 locations where we've spent a lot of money building our network in 65 cities, it also takes up half our network. Our ports grew and was up nearly 18% at 1,986. Our revenue was up 33% at 2 million. Customers grew double digits, 787, and again, total services 5,414, up from the 4,200. And our gross margin here on an exit run rate, for the reported period at the end of December, was 38%. Comparable number was 28, excluding the standards, and this is up from 22% at the end of June to 38. So looking at this graph, and I think this is the one that really brings it home in terms of what we look at when we built the business model back in 2015 to understand how this should look and how it should operate. If you look at the December 2016, which really was the first, we only launched the business really in early 2016, very little revenue. You can see a lot of money in OPEX was spent on headcount as we started to build out our network. The gross margin improved a little bit, but we concentrated on making sure we had the decent footprint and getting into the tier 1 and tier 2 markets, as you recall. So going from December 17 and 18, and in the heavy investment in as we had in the early part of last financial year in headcount and sales organisation to drive the revenue. And we're now seeing the impact of that this financial year. As you can see, the first half, the revenue has jumped up quite substantially compared to comparable periods in December and prior years. The gross margin is now running at 38%, as I said, but the EBITDA margin is now down to negative 10%. So it's changed quite a lot in 12 months in our business. We still have to add some more costs in here, but we have the luxury at this stage of adding them in at the pace that we need to add them while we continue to grow the revenue in the business. So it becomes a much more measured approach. And it's not inconceivable that this will be EBITDA positive before the end of the financial year.
On a run rate basis.
On a run rate basis. Thanks, Steve. In terms of the European business, slight uplift in the data centers only by a couple of sites, but you recall we added 6 countries and we had a heavy lifting in Q4 of our last financial year where we added 36 sites, and there was a good chunk of those went into Europe. Total ports up 720, the revenues at 900,000, services 2,116, and the gross margin here is at 59% compared to 52 excluding the ASSB, but the gross margin in Europe at the end of June was 40%. And then this chart, you can see again, same story here where we're going from December 16 up to December 19. While we're not seeing the same amount, or it's a little bit more conservative in cloud usage and adoption, we've very much taken a stance that we follow the cloud in early days, but we've been managing with the team quite well, and we haven't been adding that much cost in here, so you can actually see the EBITDA margin is improving, notwithstanding we don't have the same level of growth on the revenue line as in the other 2 regions, but we expect that to happen. And as somebody asked me in the question, as soon as the digital realty transaction closes with Interaction, we expect that to have a big improvement on our European business going forward, just access and the ability to sell through with our partner. In terms of business update, just very quickly, illustrating the growth in ports in the bottom chart. These are all per the quarterlies that we released, but you can see that the number of services above the dark blue chart is growing at a faster rate. In other words, customers are taking up more connections on their port to connect to more services. And overall, the monthly recurring revenue at 4.6 has jumped up 26% in 6 months from June. Some other stats that we had earlier on, installed data centers are up 6% at 317, customers up 13%, and both ports and services up 20%. The average revenue per port is now at 936, up 6% from June. We expect to have that having more of an impact in the second half of the year as those existing customers, now new customers that came on in the last 6 months, now bed in and continue to spend and use more in the second half of the year. One of the more important slides in the presentation, where we've spent a lot of time probably over the last 12 months working with our partners and extending their reach, is the cloud service providers. We are still today the largest provider with the most access to cloud on-ramps globally today. We have 156 on-ramps connected on our network. It's up. We added 24, 6 of which were in Japan, up 18% in the 6 months. We've also added an additional 12 cloud regions, up 14% in the period. And what the cloud providers are doing now is decentralizing away from the original traditional markets. And you can see Oracle announced they were going into Melbourne, which they were already in Sydney, and they're starting to pick extra cities so that they're actually facilities and their infrastructure is now nearer and closer to more and more customers rather than having to traverse longer distance. And we're the exact complement to them in terms of how we connect customers quickly to the cloud provider regardless of where they are. We've actually spent a lot of time on our quarterly business reviews working with the cloud providers as they show us their roadmaps for the next 6 and 9 months as to where they're going and what countries, so that we're building ahead of them in time so that we can get connected to services. So that was a heavy emphasis in this second half, or this half of the second half of this calendar year, but the first half of our financial year was to fulfill on some of the building out of these locations that we're working on in the first half of the year. In terms of Megaport Cloud Router, just a quick update on that. We have 228 instances of Megaport Cloud Router on the network. It's up over 30%. Starting on the left-hand side, the average revenue is $4,711 for an MCR customer on our network, compared to only $2,473 for a non-MCR customer. The reason we're calling this out, and we have in the last few presentations, is this is a higher value add product. It's a layer 3 product. It abstracts more complexity and makes the solution easier for customers, particularly and predominantly for multi-cloud. So how do I connect Oracle and AWS? How do I connect Google and Microsoft together so that even though they're both in physical different locations, may even be different cities, that they're seamlessly be able to move their data between one and the other. And as a result of that, the number of services that our customers, or the number of VXCs that customers are using from their portal for the MCR, is now standing at 13.5 for an MCR customer versus only 7.8 for a non-MCR customer. So again, what it does is it drives more connectivity and in turn drives more revenue per port in general. The revenue per MCR is standing at $700. It was $550 at the end of June. So as we see more and more of those connections per MCR, it's actually driving more and more revenue and connectivity. And the spiral graph. This is probably the last time we'll present this because it's turned into a bit of a blob on the far right-hand side in the top right-hand corner. But we started with these graphs back when we did the IPO, and we're pretty scant at the time. There was only a couple of lines across them. But you can see from the top right-hand corner the density of the ports on the outer ring, illustrating the 4,800 odd ports that we have in our network, and then the blue lines in between representing all the services that are connected on our network. 65% of all of our connections are ending with at least one cloud service provider, if not two. So that's what we're seeing as a definite trend. Hybrid cloud is becoming more prevalent. It's the number one reason why customers are using Megaport to connect to their services in a fast, secure, and reliable manner. Just to call out some instances, around the 2 o'clock position, there's 2 dark endpoints. The one on the top of the 2 is Microsoft Azure, and the one just underneath is AWS. So Microsoft Azure have completely caught up on that gap that AWS had a vast lead on. And the one just around the 1 o'clock position here is Google, Azure, and AWS. And just very quickly, just to end on about Megaport, just the value proposition. I think it's important every time I get this opportunity to just to reiterate what exactly it does. But it's a unique platform. It's fully interconnected with all the cloud service providers and data center operators. The pricing is a pay-as-you-use consumption model, which is very different from traditional networks where you pay for long-term contracts, fixed capacity. It's real-time provisioning. So what it really means is that the end user or the IT user can actually log onto the platform and move and change either speeds or connectivity, or have the choice of planning out their IT needs based on business and point and click and consume, which is very different from actually having to build something which takes 90 or 120 days. It's flexible terms, and again, like I said, we're continuing to add more and more providers onto our ecosystem so that the end customer has a choice of what they want to use and how they want to connect through an intuitive and easy to use portal. And lastly, just in terms of the ecosystem, just a reminder, is like 1,679 customers, and even though we're enabled in 552 data centers, we're working with 99 different data center operators across the 21 countries today, using Megaport's value proposition or Megaport's platform to connect into over 346 providers, of which the top cloud providers are as I said earlier on, account for 65% of our demand.